The looming storm over America's employment landscape is gathering momentum, casting a shadow of uncertainty over the nation's economic future. The recent July jobs report, coupled with the downward revisions, has confirmed what many have feared. The U.S. labor market is losing steam, a trend that has been hinted at by various indicators for several months. This stagnation is not only worrying, but also raises questions about the underlying forces shaping the economy. The July figures revealed a mere 73,000 jobs added, significantly lower than the projected 115,000 and only half of what was initially reported for June. Moreover, the gains for May and June were revised downwards by a staggering 250,000 jobs. These numbers paint a bleak picture, with the 3-month average plummeting to just 35,000 jobs added, marking the slowest pace of job creation in nearly 15 years, excluding the pandemic-induced job losses. But here's where it gets controversial. President Donald Trump's response to the grim statistics. He terminated Bureau of Labor Statistics, BLS, Commissioner Erica McEntarfer, alleging without proof that she manipulated the figures for political gain. However, revisions are a standard part of economic data analysis, aiming to refine accuracy as more complete information emerges. There are plausible reasons for the revisions in May and June, which we'll delve into shortly. The upcoming August jobs report is eagerly awaited, as it promises to shed more light on the health of the labor market, a critical pillar supporting the U.S. consumer and economy. Economists predict around 80,000 jobs to be added, with the unemployment rate expected to remain steady at 4.2%, according to FactSet estimates. Yet the reality is less rosy than these projections suggest. Dan North, Allianz Trade's senior economist for North America, observes that the labor market is indeed experiencing a significant slowdown. Through July, the U.S. economy has averaged about 85,300 jobs added per month, a sharp decline from the 153,300, 240,400, and 466,850 jobs added in the corresponding periods of 2024, 2023, and 2022, respectively. This deceleration was anticipated, given the post-pandemic hiring surge and the need for a new normal. However, the question remains, is the current job market merely pausing or undergoing a fundamental transformation? The slight increase in July's unemployment rate suggests that labor supply is contracting at a similar pace to labor demand, creating what Federal Reserve Chair Jerome Powell described as a curious kind of balance. This could imply that fewer new jobs are required to sustain stable employment levels. The factors contributing to the labor market's challenges include an aging population and reduced immigration, leading to a shrinking labor pool. Additionally, the Trump administration's unpredictable tariff policies have introduced significant economic uncertainty, causing businesses to adopt a cautious approach to hiring. Despite this, layoffs have not escalated, offering a glimmer of hope amidst the gloom. The weekly jobless claims report, a key indicator of layoff activity, has shown a relatively optimistic trend since mid-June, with claims remaining below last year's levels. However, continuing claims have approached 4-year highs, highlighting the difficulty for the unemployed in securing new employment. This was underscored by the latest Job Openings and Labor Turnover Survey, JOLTS data, revealing that job openings have fallen below the number of job seekers for the first time in over 4 years. Moreover, the JOLTS report indicates that hires, quits, and layoffs have remained largely unchanged. Yet, there are signs that layoffs could increase in the coming months, as evidenced by the 85,979 job cuts announced by U.S. employers in August, up from 62,075 in July. This marks the highest level of layoff announcements in August since the Great Recession, according to Challenger Gray Christmas's Job Cut Tracking Report. Economic data revisions are common, especially as more comprehensive information becomes available. During economic shifts, these revisions tend to be more pronounced. William Beach, the BLS commissioner during Trump's first term, notes that large downward revisions typically occur during economic downturns, followed by upward adjustments during recovery phases. Part of the May and June revisions can be attributed to small businesses, delayed survey responses, and changes in seasonal adjustment factors due to unexpected drops in state and local education hiring. The U.S. labor market's reliance on a dwindling number of sectors for job growth is a cause for concern. In July, healthcare and social assistance were the sole drivers of job creation, a trend expected to continue in August. Other sectors, except for leisure and hospitality, are likely to experience minimal or negative employment growth, with notable declines anticipated in professional and business services, retail trade, and manufacturing. The unemployment rate for black workers has surged, climbing from 6% to 7.2% over the past 2 months, reaching a 4-year high. While demographic data in the household survey can fluctuate due to smaller sample sizes, a further increase in August would indicate a severe deterioration in the labor market situation for black workers. Historically, a rise in the black unemployment rate has served as a warning sign for a broader job market slowdown. Annual growth in average hourly earnings is predicted to slow to 3.7% from 3.9% in August. However, this decline in wage gains coincides with rising inflation, placing additional strain on consumer spending. Employers' focus on wage containment in a sluggish economy could result in further deceleration of wage growth to 3.5% by autumn. The Federal Reserve's decision to cut interest rates in September seems almost certain, with the CME Group's FedWatch tool indicating a 96.6% likelihood of a quarter-point reduction at the September 16th to 17th meeting. Nevertheless, a stronger-than-anticipated payroll figure could prompt some policymakers to hold off, according to RSM U.S. Chief Economist Joe Brusuelas. He suggests that a figure below 50,000 would lean towards a quarter-point rate cut, whereas a figure at or above 100,000 would likely delay rate cuts until later in the fall or early winter, requiring closer scrutiny of September's inflation data in the Consumer Price Index and Personal Consumption Expenditures Index. This is the part most people miss, the intricate web of factors influencing the U.S. labor market and its potential implications for the broader economy. The current state of employment is a reflection of structural changes, policy impacts, and external pressures that require careful consideration. As we await the August jobs report, it's crucial to remember that the numbers tell only part of the story. What lies beneath the surface? The experiences of individual workers and the resilience of the economy will ultimately shape our understanding of this pivotal moment in American employment history.